Good afternoon, everyone. It's January 10th, 2015. In this week's video, I'll review the Spiders ETF, the USO, the XLK technology, and the IYT transports. But before I do so, a few points of interest. First, and as most of you know, I'll be offering a complimentary service, hopefully beginning in February, although the due date might have to be pushed back as far back as April. It all depends on how quickly and swiftly hotstockmarket.com, which is the site we'll be partnering with, transitions from the current platform to a new platform. Um, as we get closer to the launch date, I'll make sure to bring you up to speed. That way you can sign up beforehand and sort of get all the facts straight before the service actually begins. Uh, so what is the service? The service is a day traders live chat room where I'll be recommending a few day trading ideas that you can implement alongside. Ideally or conceptually, how I've thought of the program is one where those that are or those that form part of the day traders live chat room are able to sort of remotely access my computer or my computer screen and see how I identify different trades, how I'm looking to execute those trades, and ultimately what I'm looking to get out of each trade. If you're a novice trader or you're experienced, it doesn't really matter. I think the service will really benefit both breeds of investors. If you're new, not only do you get to learn the basics of day trading and treat this more as a long-term investment rather than a hobby, but you also get to interact and exchange ideas with like-minded investors and make some money alongside. Whereas if you're an experienced trader, you get new trade ideas that you might not have thought of, and you also get a peek of how other individuals approach the markets and sort of make any changes that you think are necessary to really become a better day trader. To that end, subscription wise, we'll still be offering a stock trading service and stock trading service and monthly market report. Just briefly, the stock trading service is a Monday through Friday service where each week I share with you up to 4 trades that I'm looking to execute over the next few weeks. And each daily newsletter has sort of a brief summary of each trade, showing you why I designed the trade the way I did, um, and what I'm looking to get out of the trade. If you're someone who wants to grow as an investor, as a trader, and sort of wants to wrap around meaning to what we're doing, then the stock trading service and monthly market report is for you. You'll get the daily newsletters that run from Monday to Friday, but you also get a monthly market report, which is a 10 to 20 page write up at the beginning of each month, where I sort of narrate some of the most important events of the previous month, and then with the use of different indicators and tools and whatnot, assess current market conditions to draw on future trends. So basically, you get a easy to follow format to try to make sense of what's going on in the markets. And over time, you'll get sort of exposed more to what the markets are, and grow as an individual investor. So if you're interested, send me an email at smartstocks8@gmail.com, or simply click one of these tabs and it'll redirect you to the appropriate payment page. Performance-wise, since it's the beginning of a new year, we're starting with a new slate. So far we've closed 2 trades for a profit. Our long-term objective remains to enhance future returns while keeping risk in check. Um, the trades we placed in 2015, I'll have a link to those trades by early next week. That way you can sort of compare the trades that made us money versus those that lost us money, and how we did overall. That way at the end you can make an assumption of whether or not the service sort of complements your style of investment, and if it really just works at the end of the day. If it does, then like I said, I look forward in working with you and hopefully building on a profitable year in 2016. And lastly, on the blog, there's a new blog entry where essentially I took a bird's eye view of the market on the first trading day of 2016, and it's one where I share with you important points that you should consider short term. And even though I'll touch on some of these points in this week's video, if you're still interested in reading the write up, please do so. You're more than welcome to do so. If you have your own comment, make sure to sort of drop a line at the end. So let's begin by taking a look at the S&P 500. To be quite frank and honest, I had originally expected the S&P 500 to test in this downward daily channel, which I've drawn over here, at least through the duration of January. Little did I expect the S&P would gap below and end the week at its lows, undercutting first order and second order of support. The good news, and this is really the only bright spot I could sort of take from this week, is the fact that the gap that was made on the 5th of October was closed or filled on Thursday. That means longer term that when and if the S&P 500 were to break above the current 52-week high, the move above that high will be that much stronger because a lot less gaps are left unfilled, and that just means that there's a bigger there's a bigger base formed at the bottom, right, of the range leading into that breakout. So longer term, it would be bullish. Short term, though, it's a bit preoccupying, and here's why. First order of support priced between 197 and 198 spiders, and second order of support priced between 193.57 and 194.37 got taken out. Unless second order of support gets reclaimed next week, you really have to think. There's little doubt in my mind that third order of support, which is what I'm calling it, at 189 roughly spiders, is going to get contested. And if you go across space, that comes right in line with the rising trend line that dates back to 2011. What defines the midterm trend is the rising trend line from 2011. So if this trend line were to get violated, that means that not only are the short-term trend, it's not only is the short-term trend bearish, but now the midterm trend, something that hasn't happened since 2011, would also be bearish, leading to a possible much bigger sort of waterfall decline or rollover than many would expect. From experience, every time any product, doesn't matter the market environment is really of little consequence here, but every time a third point gets contested, that price point oftentimes offers less support or resistance in that third attempt. So for those of you who expect 189 to provide strong support, you're just fooling yourselves. That's it doesn't happen. The fact that price again has to contest this price support point for a third time without making a new high shows the internal weakness of the market. And so what you'll see is less support at these prices and more and a greater deal of support at much lower prices. In this case, priced at around 178 spiders. So what I'm trying to say, if anything, is that 189 is not going to offer as much support as it did back in October 2014 and October 2015. And if violated, you have an additional 100, 110 points to the downside in the S&P 500 before there's any attempt of a relief rally. And if 178 gets taken out, you're talking about a move down to 155, 156 on the spiders. So really what's at play here is not just another 30, 40, even 50 points in the S&P 500. It's at least 100, 110 in case 189 gets taken out, and as much as 400 points. So just be mindful of that. What would make you less preoccupied with less bearish markets? Again, if second order of support gets reclaimed, but more importantly, first order of support, and even if this downward daily channel, this lower band to this downward daily channel gets sort of reclaimed in fairly short order. Until then, you have to be respectful of price. Now, would I short a trade below 189 to 178? No. Would I short it from 178 to 156? Yes. But if 189 were to be taken out, then the best thing, truly, this is the best advice I can give you. I would simply sit on the sidelines, even if it's for a month, for 2 months, because I can guarantee you that sooner or later, that $178 level, if 189 is broken, is going to get contested. And when it gets contested, you're going to get much better bargains. But obviously, You have to remain patient, and patience is not a virtue most investors have, unfortunately. But that's really the best advice I can give you under such a circumstance. Um, if you look at the USO, it remains in a long-term downward trajectory. Back in the middle of December, I thought some type of a relief rally could be in play because this downward accelerated downtrend got taken out to the upside on this day on the 24th. But notice that even after the downward trend line got taken out, price didn't sort of proceed to trade appreciably higher, which is what you normally see when shorts get trapped. In fact, price sort of meandered around the trend line before it gave way to lower prices. So because there was a lack of conviction and there was no really added momentum to push price higher, I decided not to take the trade. And lo and behold, that proved to be the right decision. Didn't make me any money, but didn't cost me any money. Now, as of this week, Thursday Gravestone Doji opens the possibility of another possible bottom in oil, where it's a short-term bottom or a longer-term bottom. I have no idea. It's too early to tell. But again, if you're a candlestick practitioner, one would be sort of inclined to believe a possible bottom may be at hand, as long as anything between 9.80 to $10 USO holds for the next few days. But even so, again, we would have to see the accelerated downtrend get taken out and price quickly sort of advance from that price point on the break to really validate it as a trade. So what am I looking at? I'm only interested in trading crude oil, whether it's for a day trade or a short-term trade to the upside. If $10 on the USO holds and then proceeds to trade above 10.15 to 10.20, for a trade up to at least 10.50 to 10.60, that's 3%. Not much, but it's a high probability trade. And as high as 11. So that's changes from being a 2 to 3% trade to possibly a 6 to 7% trade. From there, we'll have to assess market conditions, but it's a possibility I'm looking at. And that's really all I have to say about crude oil. Until other than that, there's really not much to say. We'll just have to wait and see. I mean, could crude oil trade down to $25 a barrel? It sure can. But I'm not going to form. I'm not going to form part of that trade just because the big point move has already been made, and it's just there's no reason for me to trade an additional $6 in downside when I know there's $10, $15 in upside. So it's just not something I'm interested in. You focus on the sectors of the market. What was leading markets higher back in November, December continues to act okay, but bear in mind that the 50% fib retracement to the current range is currently being contested. If you're blindsided, as I was, from this week's decline and you're still holding on to technology only, then it's okay to hold on to those stocks for now. But I would advise that if the 50% fib retracement or even a 38.2% fib retracement get taken out this week or next week, you really either have to pare down risk considerably, and by considerably I mean selling 80% of your holdings and leaving a very small amount out there, or just closing out the positions altogether. Until, again, this 50% fib retracement mark gets sort of recaptured and we see a price proceeds rather to retest these upper fib retracements. That's basically all I want to say about the XLK. And as for a lagging sector that was and remains a lagging sector, the IYT or transports, it's at a critical juncture given how price is contesting the this lower time rate, which is a monthly time rate, and the trend line that dates back to 2011. If we get a week-to-week close below both of these support bands, meaning if we end the week next week below these support bands, market bears, make no mistake, will target 108, this fib retracement. Of course, initially you'll see some support coming in line between 118 and 119, right? 118.16, 119.48. But ultimately, they'll want to target 108, maybe as low as 103.28. So basically what we're staring at here is a major inflection point in markets that could have a cataclysmic effect in price in very short order. In other words, we could see a price decline in the S&P 500 like it never even happened of 200 or 300 points in a matter of weeks before price finds its footing. Again, that's all subject to change, but as of now, that's the risk of it happening is growing louder. So just be mindful of that. So again, this is a week where it paid to be a market observant more than somebody that actually placed a bunch of trades out there. I mean, if you made money, congrats. If you lost money, it sucks, but it's part of the business. Just sort of see what you did wrong, where it went wrong, and how you can improve. That's all I can really say. I'm not gonna make any bold calls as to what's gonna happen next week. Until next week, because there's not much information for me right now to truly make an accurate market assessment. But next week is very important because of where we close the week this week. So, with that said, remember, stay nimble, respect price for what it is, and please do not trust markets. It just never ceases to amaze me how firms like Goldman Sachs, or you name it, Goldman Sachs issued back in December, November, 100 or reiterated, it's $143 price target for Apple. You really have to question these calls. If Goldman thinks Apple is going to go to $146 and the stock is trading at 97 today, why the hell are they not buying a bunch of stock? I mean, it's an implied 50% move. We're not talking about 1, 2, 3, even 5%. We're talking about a 50% move. If it's such a big move, why the hell they're not liquidating everything else and going into Apple? And then another story that just boggles the mind is Fitbit. The price consensus among a bunch of firms, Barclays, William and Baird, you name it, Canaccord Genuity, you can throw everyone out there. It's for 40. The price consensus on Fitbit is $48 a share, and the stock today trades at $22. That's an implied upside of over 100%. Again, why aren't these firms buying the stock like crazy if they think it's going to go up to $48? Again, just this this points to how untrustworthy Wall Street is, how you can't rely on these price targets whatsoever. I mean, at all. Forget they even exist, and really what their agenda as firms truly is. You have to remember a William and Baird or a Cantor Fitzgerald, all these sell side analysts, they're there to sell you stock, right? Yes, there'll be times where they'll be right, but believe me, out of 10 times, 8 will be completely, and I mean when I mean completely, I mean dead wrong, and 2 will be they'll hit it out of the ballpark. But if you rely or even fall into temptation, as I've done recently, to sort of fixate your um your your investments on that, you're gonna lose money. So just out of experience, the best advice I can give you is to completely forget they exist because they will throw you out for a loop and it'll cost you money. So just be mindful of these. And again, it's just worthless. These type of price targets, if you want to call it that. But in any case, thank you for taking the time to watch the video, and I'll talk to you next week.